half an hour away from the Opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Asian stocks dropping with Chinese assets facing pressure as we approach the Open. You have fresh trade tensions between the U.S. and China, but a bounce in U.S. futures suggests investors are pulling back from worst-case scenarios with President Trump opening the door to a deal.
China warning of retaliation and urging further talks after Trump announces plans on double tariffs on Chinese goods, along with sweeping curbs on critical software. Stay tuned for top insights on the trade war and markets throughout the program.
Plus, the NBA returns to China, working to rebuild its brand even as geopolitical tensions continue to rise. From the Asia Pacific, welcome to the show. Hope you're all well. Looking at the approach to the Open is a bad one. It could have been worse given the latest lines coming through and the opening of that door, of course, to perhaps a path towards a deal. But all that being said is just to say that we are expecting Chinese markets, as you can see on your screens, to play some massive catch down given where markets traded into the weekend. Flip the page, please, if you want to get an indication, of course, of some of these ETFs in the U.S. or the big names. So you have ASX, you have the CSI 300 tracker on your screens. We were down 4.5%. This is as of Friday. Just again, take note. Crane shares maybe at play on tech. And we were down closer to 8-9% in some of the big tech names. This is on Friday. Right. Now, the good news is, and us pulling back from the edge, is really some of the rhetoric coming through out of Donald Trump before he got on Air Force One about 3 hours or so back. He says the November 1 is still going to happen, but he is confident that he could hammer out something. Asia Pacific stocks coming up on your screens. Take note, Japan is shut, although the poll we're getting today is as of this opening in Taiwan. We're down 3%, 0.6%. But the good news, as you can see, is the yen is on the weaker side of things, and of course S&P futures are catching a bid Monday morning. Very quickly, gold, oil, copper, and crypto hit massively, of course, and we are seeing some green on your screen, which I guess is indicative of this slash détente we're getting as far as this risk sell-off is concerned. Just very quickly, so we're looking at 2-3%, right? Going into the Open today, decline. So the 50-day moving average is going to be very much in focus today. That's coming up very, very shortly because currently we closed above, just about 3% above that level. We'll see whether we test this and whether or not we bounce across this support.
Yeah, you got to wonder, right? Is this just political noise? Is just posturing ahead of this APEC meeting, and whether, does it put in doubt now whether these presidents could actually meet in Korea? Certainly that is a big question, but you mentioned about, there is a bit of buffer given what we heard from those Trump comments overnight. And it seems like in some ways, markets are taking this, at least in some cases, stride. You do see a bit of cash down, as you mentioned, but there are nuances where people are looking past this here right now in terms of what to watch in the agenda. So we talk about where things stand in the U.S.-China trade talks here right now, the national team ETFs, whether we do see any sort of buying from that end, gold mining stocks, of course, and basically anything that's really risk-related here this morning. Trade data, we're still expected coming through for September, so interesting to see how those numbers feel and how strong really the export side of things continues to be. That renminbi fix could be quite telling today, given some of the FX moves we've seen, and of course, offshore HIBOR as well.
Yeah, lots to watch going into the Open today. Also, in the last 30 minutes, just to mention, of course, we're looking at shares of China Vanke following the resignation of the chairman. Right, now back to the top story. So on Friday, had President Trump upping the rhetoric as far as trade tensions go. You had a statement coming out of China on Sunday, Ministry of Commerce, and then a few hours back, President Trump, as we were just alluding to there, pulling back ever so slightly from the edge. Let's bring in Min Lo, of course, a China correspondent. She's with us out of Shanghai this morning to help us understand where we are. Min, can I just bring you in here, then we'll talk about some of what we've heard so far. So get us up to speed here.
Yeah, well, this morning, President Trump appears to be offering an off-ramp to China, right? He praised President Trump, President Xi on Truth Social. He said, don't worry about China. Highly respected President Xi just had a bad moment. He doesn't want depression for his country. Neither do I. The USA wants to help China. We're hearing similar tones from J.D. Vance on Fox News as well. He's calling on China to take the reasonable path here, saying the U.S. will also be reasonable if China is as well. But so far, I've been in Shanghai over the weekend, and I've been speaking to people here from the private sector, from official circles, and also from what we're seeing on Chinese state media as well. It seems like the sense I'm getting here is that China feels the U.S. is acting on bad faith, and the U.S. credibility is at stake because there appears to be this implicit understanding after the Madrid talks that both sides are going to keep things calm until Trump and Xi meets. And there was a clear warning from President Xi in his phone call to Trump that any unilateral actions could undo the multiple rounds of trade talks so far. But look what happened over the weekend. The Chinese Commerce Ministry officially defending its actions, saying the U.S. was the one that took new restrictive measures. The first big one came just about 10 days after that Xi-Trump phone call when the U.S. expanded the rules around the entity list. And that really kickstarted this whole spiral of China tightening the noose on rare earths, both sides imposing those shipping levies on each other's vessels docking in each other's ports. And that's where we are today.
Yeah, it brings us back, almost a throwback to what happened back in April, right? Markets in some parts of it at least are feeling it. I want to bring up that soundbite from the president who just spoke about opening the door still to a trade deal. Let's listen in.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. And I have a great relationship with him. I think we'll get it set. I know what happened. I really understand what happened. And I'm not even saying he's wrong. But then we met him with something much tougher than what he did to us. Again, because of the tariffs, it's much tougher.
You mentioned tariffs, so we're talking about 100% tariffs now, once again. What are the implications, Min, for the Chinese economy, and what other options does China have at this point?
Well, obviously, the biggest implication is on trade, right? It has the potential to just rupture all trade between U.S. and China, and U.S. importers will have to find other sources of supplies. So that's the big implication here. But I want to point out, so far, China's actions, the rare earths control especially, is the strongest attempt by China yet at long-arm jurisdiction because it applies to overseas exporters of goods that contains even trace elements of Chinese rare earths. Now, if that sounds familiar, it's because it's similar to the FDPR rule that the US has, Foreign Direct Product Rule, which the US used to apply on China to restrict its access to US technology when it comes to semiconductor equipment that are made outside of the US. So it's China's first attempt, or the strongest attempt yet at this extraterritorial rule. And that's a big leverage that China has. And the Chinese Commerce Ministry over the weekend clarified that this is an export control. It's not a ban. There is a clear signal here that there is a space to dial down tension because they're saying they're willing to work with countries to smooth things over, to allow stable flows of those rare earths if they work together with one another. So we have until November 1st, about a couple of weeks from now, for both sides to dial down tension. But of course, China also has other tools in its toolbox. It is able to disrupt other economic engines of the US. You think about Apple trying to diversify its supply chain out of China. But so far, that's been stalled by Beijing, restricting Apple's ability to work with the likes of Foxconn and other Chinese contractors that are key to Apple. And here's what one businessman that was here in Shanghai over the weekend had to say about the impact of tariffs. Have a listen.
We have to see how tariffs sort of come out at the end of the day. We'll see what happens, particularly with the negotiation between the US and China. Having said that, all that does is delay things. I mean, people, when there's an uncertainty, they don't make decisions. I'm talking about the advertising industry now. They don't make decisions as quickly as they should do, or they postpone making a decision because they're uncertain about the results. So it's not good news.
That was Martin Sorrell, who is the head of a global advertising agency, and he tells me he's still bullish on China because he's confident that Chinese companies are agile enough to shift with the global trade flows. As you can see from the trade data today, expectations are we're going to see an increase in trade year on year in September.
All right, thank you, Min Lo, there, our China correspondent joining us out of Shanghai here this morning. Let's bring our next guest, Zhikai Chen, head of Asian and Global EM Equities at BNP Paribas Asset Management. Zhikai, it's great to have you here in our studios. Does it feel like it's almost like brings us back to 6 months ago and really this back and forth and tit for tat that we're seeing between U.S. and China? And what do you do in terms of investments now?
I don't think it's avoidable, right? I think we've been in this particular type of watching for news flow, watching for any tariff news overnight since pretty much November of last year. I think this is a new phase, shall we say. I think a lot of the large economies have reached tariff deals with the U.S. administration. I think this is the biggest one that's still outstanding. And I think about a week or two before this latest warning from President Trump, we saw that there was probably some signs of deterioration. You saw that both countries were looking to ratchet up further controls about exports to each other or sensitive technology. And obviously China had a new regulations on the rare earths. As mentioned earlier, like even trace amounts will now be controlled. I think that probably rattled a little bit of the US administration in terms of what they wanted to do, and hence the warning on Friday. Marcus really sold off. We probably will follow a little bit today, but earlier today before he left for the Middle East, we obviously saw a little bit of a de-escalation with the possibility of a deal or meetings.
Yeah.
I think it's also important to note that why he chose November 1st. I think we forgot that the APEC meeting is in Seoul at the end of this month, and I believe the last day is November 1st for the leaders' meeting. So perhaps this lays the groundwork for some negotiations behind the ground and perhaps a personal meeting face-to-face between two leaders. And we just have to wait and see. Unfortunately, we are held to these type of events, if you will, investing right now.
Right. That we're likely going to get a gap lower at the open. To your point, so would you buy today's dip? Would you wait 2 weeks? What's the short-term view from an asset manager?
We do not make a lot of short-term trades, if you will. I think this is something that we've been watching for since beginning of year. Yeah. I think one of the as I mentioned earlier, this is one of the big ones that's still missing in terms of tariffs. Initially, thought that we have until like mid-November to decide, but I think this is something that is coming to fore now. I think the markets will adjust. We are relatively well positioned. I think in terms of where we are right now, we're not looking to making any knee-jerk moves ahead of this news. Yeah.
It's coming at a time when China markets are, this slow bull run has been doing very well in some ways. Do you think there's any risk of this being upended now in the China market, especially when it comes to these big beta plays that people have been really kind of piling into?
Hard to say. I think from where we are here, from beginning of year, obviously has been a great run in Chinese equities. A lot of the large caps have gone up a lot. I think this is reflection of the fact that at the very beginning of the year, a lot of investors were really underweight Chinese equities, if you will. Then with the DeepSeek moment, seems so long ago, it raised a new fervor of investment into Chinese equities to see if there's any alternative investment destination, if you will, for AI exposures. I think this will probably continue, if you will. I think most investors now are probably neutral, but I wouldn't say that a lot of people are very overweight Chinese equities. And obviously what has happened in the last quarter or so has also caught the eyes of domestic investors. They're also piling in. So we just have to see today's correction and see what the markets react to it, and wait for further news between the two administrations in terms of where the tariffs will end up.
Zhikai Chen, of course, we'll have more with him in a couple of minutes, get into, of course, some of his other conviction calls. Head of Asian and also Global EM Equities at BNP Paribas Asset Management. Also ahead here on shows, much more on these renewed U.S.-China trade tensions, and really what a reminder from Friday. As you can see, we have a great lineup of speakers coming up out of Goldman Sachs, HSBC, Lotus Asset, and also the head of China practice at Eurasia Group joins us at those times, throughout the course of this morning, counting down to the open of trade. Shanghai, Shenzhen, and here in Hong Kong, futures are pointing substantially lower this Monday morning. This is the China Show. Welcome back. Right, so the renminbi fixer today is out. This is important because this does give the PBOC maybe an opportunity to backstop some risk Risk appetite today, as you can see, we're now stronger in the Chinese currency. We still have a trading at about 713 handle, though. 710 is the midpoint of the day coming through out of the Chinese central bank. Yeah,
Zhikai Chen is still with us here at Asian and Global EM Equities at BNP Paribas Asset Management. We're just talking about some parts of this kind of China rally that still remain quite strong. I mean, you've made some adjustments, though, when it comes to the consumption space and the like. Tell us a bit more what you've done.
So, since the beginning of the year, we've taken some of the consumer discretionary space, particularly on the concern that there's more competitions going through. As you know, one of the big companies decided to enter several lines of competition. And that's led to quite a bit of concern about how the margins are going to look for some of the e-commerce companies. So we've dialed some of those exposure back in discretionary and put them into some of the IT hardware space to take advantage of the fact that post the DeepSeek moment, we have seen the hyperscalers in the US continue to ramp up their CapEx. Going into AI continues to exceed people's expectations, and that's obviously quite positive for Asia, because at the end of the day, we are the AI supply chain for the rest of the world. So that has been helpful so far this year.
That's interesting, given, to your point, people have been trying to figure out how to best play AI in China, and I think for the last, let's call it 4 weeks or so, some of the platform companies became those proxies.
Yes.
So you think hardware is the best way to play that as far as China goes?
I think hardware is one area we are confident that when we do the numbers and look into the structural flows, we can at least hang on to the fact that the CapEx are coming through and the CapEx will need to be spent, and some of these companies in our economies, particularly in North Asia, will be the one to benefit from this increased order flows, the likes that we've seen in South Korea as well in Taiwan as economy basis. In China, it's a bit more tricky. I think there's still quite a bit of advancement, definitely in terms of AI models that have been put up by the large platform companies. But at the same time, it's not easy to basically identify a stream of revenue that's going to come through from some of these companies at this point in time, directly related to AI. So we are positioned in there, and we are benefiting from some of those appreciation on prices that we've seen so far. But right now, it's not easy still to find, like, say, tie the AI team to the AI revenues flow in some of these Chinese companies right now.
And tell us about the pool of investments. I mean, does it look like it's just quite limited to names that we don't really know at this point? I mean, you talk about this kind of scarcity premium.
Yeah, there's definitely a big scarcity premium in some of the local AI chip companies, right? So we've taken a look at a couple of them, and the multiples are really quite breathtaking. Some of those names are trading at 300 times PE. When you look at the world leaders in terms of AI chip design, they're nowhere close to that, right? And some of these companies are probably still barely profitable, breaking even, if you will, next year. So it's very difficult for us to basically take the leap of faith and basically go into some of these more domestic-oriented AI names at this point in time.
Do you have enough quality information on those companies? I think Yvonne and I were joking about this, I think about 1 or 2 months back. A name like Cambricon, for example. No one had really talked about it to this extent. And then here we are trying to understand what the company does, what they do, and to what extent. As someone on the buy side, do you think you have enough sell-side support as it pertains to that cohort of that ecosystem?
Still very new, I would say. I think the sales are also busy doing their work on companies like this. But as you can see, this is something that's quite new. Again, it seems so long ago, but this basically took off after the DeepSeek moment in terms of perhaps a Chinese alternative stream in terms of AI design, AI models. They've already proven themselves in AI models. Then this question mark is their ability to leapfrog or have a breakthrough on the chip design part. So far, I think the jury is still out on that at this particular point.
Yeah, and it's interesting too. I mean, what's different this time around? I'm looking broadly speaking in terms of EM, is that it seems like the Fed's resumed this rate cut cycle, and which is something that is quite interesting in the face of all these geopolitical risks. Is that still a very supportive sort of narrative to kind of continue to lean into risk at the moment?
I think it is to a certain extent, right? If you look back, in November of last year, there was a lot of complicated issues that's going on. One, the labor market was starting to soften, but inflation numbers were still quite strong, so the Fed basically paused. And we've been on pause until the last meeting where they resumed the rate reduction process. And this is helpful, generally speaking, for emerging economies, because for emerging economies, a weaker dollar in a resilient US economy tends to be quite okay setup, because the overall demand is still all right from the US consumer, which is the largest consumer base in the world still. And it also allows a lot of the emerging markets central banks to have a little bit more flexibility in terms of managing their domestic interest rate to mitigate any potential economic slowdown, because they don't have to worry as much on their currency compared to the US dollar. So I think this setup is still pretty good for emerging markets right now.
Zhikai, Chen, fantastic. Thank you so much. And I guess you guys are going to sit this one out for today as far as the gap lowers.
We'll allow treat today.
Yeah, there you go.
Thank you.
Yeah, could control one's emotions given a day like today. Zhikai, Chen, fantastic. Thank you so much, Head of Asian and Global EM Equities at BNP Paribas. Asset Management, Hang Seng Index 2.5% lower, 650 points to the downside. In terms of market breadth, that should be also quite negative as far as that is concerned. So we are going into a risk-off session. How long that lasts, who knows? We'll find out. A full preview is coming up next. This is Bloomberg. As expected, equity markets are somewhat falling out of bed. Let's see to what extent and whether or not we'll get buying coming through to support these markets. But yes, this catch-down trade, not just in Hong Kong, but we're seeing that in the likes of Korea and also in Taiwan today, really on the back of this re-escalation of trade tensions.
And what is falling the most is the winners of this rally, right? They take a look at the beta stocks like the big tech. That certainly is the one where we're seeing the biggest blow when it comes to HS Tech here this morning. There you go. Alibaba's down close to 4% here right now, 3% losses for Tencent and JD.com. We're also focusing on the domestic chip space, given that this is kind of where that leveraging sort of options or tactics really are, rare earths versus really chips at this point. And there you go. You are seeing the likes of SMIC, Hua Hong Semi, also who have been darlings in this whole market as well, are also down by 2 to 3% here right now. We're focusing on some of the rare earth stocks. You saw some of the Aussie ones already react to some of these news here, but there you go. You are seeing the likes of Ganfeng Lithium down some 5%. CATL8 shares also seeing drops of similar measure. We're down 28 bucks there right now. So there you go. And gold miners, right? Oh, let's talk about Ivanka first. So there was actually some news on the corporate side of that one. Chairman resigning. We're taking a look at the stock in particular. There you go.
Down 5.
Down some 5% as well. So still, there is some news to kind of look into this, all of this, in the face of all of these kind of geopolitical noise. Gold miners, though, also we're focusing on here today.
Yeah, because most of the indicators of risk appetite today actually started to pick up, but obviously gold has been dancing to its own tune, and it's actually seeing more upside as we speak. So we're down trading back above 4,000. It's mixed across some of the gold plays. It's hard to sort of split up what we're seeing as far as the actual miners are concerned, given how far some of these names have actually rallied. The same can be said about Vanco, which actually also did see some downside, as Yvonne is pointing out, down to maybe that news, and now to maybe the risk aversion that's out there across these markets. Hang Seng Index down about 2.5% as we approach the opening bell. All but 2 stocks are actually down going into the open today. The opening bell coming up next. This is the China Show. Good morning. Welcome back. You're watching the China Show, and we're down about 2% on A50 futures. We're down 2.5% on the Hang Seng Index. In your pre-markets, this massive catch-down trade we're seeing just about across the region. Japan is shut, although similar move in futures there on the Nikkei. U.S. futures, though, are pointing to some stability going into the rest of the session. But all that said, we are expecting to see a gap lower at the open, this adjustment coming through out of this renewed flare-up in trade conversations here.
And we're watching all the proxies, right? Whether it is the chip space, rare earth space, soybeans, all the like, of really kind of what to measure how to look at these latest escalation, which was sudden. We weren't expecting this, given that we've been in this whole kind of trade truce for months now. And all of a sudden, it feels like it's April all over again, at least sentiment-wise. But then again, we talked about President Trump, J.D. Vance, the vice president, also speaking over the weekend, just trying to dial down the temperature just a little bit before his trip to the Middle East. President Trump did mention that they are still leaving the door open when it comes to some sort of trade deal as well. And we still have a couple more days until, of course, APEC. There you go. We're still seeing, though, a massive sort of gap lower when it comes to the onshore market. CSI 300, we're down close to 2.5% here right now. You are seeing that kind of rush into some of the CGB space. So bonds are catching a bit here this morning. The 30-year yield is down some 4 basis points as well. You take a look at the commodities are also kind of falling on a bed. Shanghai crude is down some 3%. Copper is also down 2.5%. And you are seeing some of these big cap names like CATL. A shares are down some 3% here right now. And we're focusing a little bit more when it comes to Hong Kong. It is that sort of tech exuberance is now at risk, possibly, just given that these were kind of the leaders of this rally. And there you go. HS Tech is down some 2%, given the fact that we are seeing these fresh threats when it comes to export curbs in AI, in chips and the like from the U.S. That's the first time that we are reacting to this here in China, right? So there you go. You are seeing when it comes to the big names like Alibaba is down close to 4%. Tencent, Meituan are down 1.5% or more. Domestic chips, though, you are seeing some nuances, right? So SMIC Huahong actually now that things have opened up are doing a little bit better. On the flip side, Capricorn Tech is going down about 0.75%, and OmniVision is going down 3%. So there you go. There's a bit of mixed reaction there when it comes to some of these national sort of champions. And the national team ETFs, we're watching very closely whether we do see any sort of buying from some of these sort of support E-Fund and the like here. Not seeing too much here right now. We're still seeing a bit of a negative reaction so far in some of these ETFs.
Yeah, it would be a good indication if there is some market support that's coming through as well. It certainly goes into the A and H share conversation that maybe the onshore markets might fare slightly better compared to the offshore markets, given, of course, that they do have that there onshore. Just to also mention, we've sort of parsed through a lot of the commentary that's come through, given the latest developments. And here is just a quick glance at what so far we've gathered from analysts talking about the escalating trade tensions between the U.S. and China. Let's start things off here with the note coming out of Andrew Tilton, Hui Shan, and their team there at Goldman. On the eco front, this re-escalation suggests a wider range of outcomes than was the case ahead of the last round of talks. There is a possibility of greater concessions and possibly lower tariffs, but also the risk of substantial new export restrictions and higher tariffs. Nomura, flip the page, please. Also coming out with there, this is Ting Lu and his team. This escalation of trade tensions is more about posturing for upcoming negotiations, including possible, and hopefully for everyone here, re-engagement, of course, in that meeting between the two presidents at APEC. And JP Morgan, very quickly, Wendy Leo, as far as strategy goes, should the Chinese stock market experience an outsized decline, which is perhaps arguably what we're seeing today, this is a window. This is a buy-the-dip opportunity that could emerge before the year end. Now, despite all of that, you have a look at the consumption sector, right? So you have our folks at Bloomberg Intelligence, because we also just happen to be wrapping up, of course, Golden Week, and we now have data on this as well. Marvin Chen and his team effectively saying here that the consumption sector could be an overall bright spot. There are nuances, of course, within the categories, but some analysts noting that positive figures during the Golden Week. Our team here at Bloomberg Intelligence notes that tourist trips hit a record high 888 million, while spending or general spending exceeded 800 billion. They say strong travel, leisure activity suggests households may finally be moving past these pandemic-era caution. Momentum was evident across dining, entertainment, and travel. The sectors most affected, of course, from events during and lockdowns during the pandemic.
Yeah. Meanwhile, Goldman Sachs is chiming in, right? So they've been talking a little bit more and crunching the numbers, and maybe not as optimistic as what Marvin and his team has been talking about, right? So they said goods consumption remains soft with downside in pricing, despite you're starting to see strong bright spots like tourism, traffic remaining solid. The demand softness we observed in the second quarter, the third quarter, continued into the National Day holiday, with sales growth of key retail and restaurant enterprises at just under 3%, which is is lower than previous holidays this year. Joining us now is Michelle Cheng, co-head of Asia Consumer Research at Goldman Sachs. Seems like depending on what metric you look at, you see different things. How would we interpret the latest sort of Golden Week data?
Yeah. So I think the biggest takeaway is there's a clear shift from consumer goods to more experience. Yeah, so I think during Golden Week, clearly traffic is really good. And of course, you can argue that it's a long holiday, so people probably travel more, so that they didn't have time to visit the shopping malls to shop. And also, you remember we have earlier Singles Day promotion activities which kick in recently. So consumers might hold back their purchasing during the holiday. But having said that, in the past few holidays, we still see holiday sales is still slightly better than the normal time. And this time, 2.7% growth only, compared with you have 6% in Labor Day and 4% in Chinese New Year. Even compared with past 2 months, July, August, the retail sales growth is like 3 to 4%. This 2.7% indeed is not too exciting. But having said that, break down into the category, we have been seeing that consumers want more experience. And also, if you look at some subsectors, there are still some bright side related to experience. And also, if the companies, they can figure out some new growth opportunities, there are still category or the penetration stories. They are still more resilient. Yeah, but overall, I think aside from the general top line number is not too exciting, one key trend we have been seeing is pricing and deflation. Yeah, so from end of second quarter, we start to see that the pricing trend turn softer, and this might continue. Even we should have an easier base in the second half.
How much did discounts help?
On the one side, you have the food delivery platform fight earlier, although it peaked out in July, August. But looking at different freshly made drink company, earlier you can buy a cup of coffee or milk tea at 15, 16 renminbi per cups. But in the recent trading, it's probably only like 10 or even below. Wow. So it's actually quite big discount. And also in some sectors, like apparel, it's actually not really the inventory issue. In China, brands and retailers, they actually have capability to control the inventory pretty well. But it's more like you need to do promotions to attract consumers' attention. So discount, again, base should be easier in second half, but we still see third quarter, the promotion activity is still quite intense.
How do you look at in subsectors, right? Everything from jewelry to restaurants to, sportswear. I mean, what stood out to you?
So a few sectors we still like, definitely those with volume growth story. So basically, we take aside the pricing for now. We hope to see some pricing improvement, but if the sector still have volume story and it's still a safe bottom support, so some new consumer ideas like IP diversified retailers, they are still doing really well, and pet foods is still doing well.
Pet food, okay.
Yeah, and also on the other side, for the bigger categories, actually beverage, no matter it's packaged RTD beverage or the freshly made drink, these beverages still relatively doing well because of volume growth. And sportswear, I think, is still relative sectors you see general volume growth. But in near term, you just see a huge divergence in terms of the brand's performance. And maybe one more interesting thing to add is we have been talking about rational spending, kind of consumer trading down in the past few quarters. But in the past 2 quarters, some premium segment is actually doing better. So in sportswear, in cosmetics, even for some luxury, you see some luxury shopping malls traffic, they really improve because of the low base. So not sure whether it's a little bit like a stock market wealth effect or it's just easy base, but in the past 2 quarters, it's a premium if you can really deliver, the brand can really tell some good stories. People still want to pay premium. But in the mass, it's really, really competitive on the functionality, on the pricing.
So would you, from an investment strategy perspective, would investors be better off leaning towards these brands or companies on the higher price points?
Not necessary. I think ultimately, I think if you want to scale, definitely the affordability is still key. So value for money, and if they can capture the lower tier city opportunities, definitely from the scale perspective, this is still the areas they can explore. But for premium segment, niche brands and in the good brand cycle, actually there's opportunity. When we look at the consumer space, even in cosmetics, in jewelry, we actually see aggregate challenges. But you can still always pick up some brands that are doing well because they have right product portfolio and right brand momentum in the coming periods of time.
What else should we be watching out for? Obviously, when it comes to the food delivery space, you mentioned about maybe we reached a peak when it comes to the competition, but in terms of subsidies, should we expect that to continue into 2026?
Yeah, that's a great point. There's a lot of debate, and honestly, to some extent, market pricing huge corrections next year, and this is why a couple of bubble tea companies, they had good runs in the first 7 months, and then share price pulled back by like 20-30%. So on the one side, we indeed admit that this makes the whole competitive landscape very complicated. But on the other side, we always think that it's not just the subsidy, because if you break down into different brands, some brands actually doing much better because they have new products. So again, still go back to each companies whether they can figure out some new ways to serve, to engage with consumers. So looking into next year, on the one side, we factor in same-store sales decline, but some brands, they probably will be still performing better. And on top of that, they have store expansion, network expansion to support still pretty attractive growth next year.
It's hard to, I wonder how you analyze the market now, because on one hand, you look at the headline number and you think, okay, overall demand is quite weak. But also, do you think part of it is consumers have just gotten used to discounts and subsidies? In other words, demand could be okay, but if people expect discounts to continue, I'm not going to buy until they give me the discounts. I wonder how you would best characterize the Chinese consumer right now.
Yeah, and this is something we also worry about. Yeah, so earlier we do see some stabilization of the pricing, and initially it's not really better confidence. Initially it's more like, if I gave more discount, it couldn't drive traffic further. So the brands, company, they started to be a little bit more disciplined. Yeah, so hopefully I think the competition will be still a little bit rationalized, and so that people will still go back to pricing, because ultimately if it's all about pricing, and then different companies' strengths in product innovations and storytelling will be just underestimated. Yeah, but so that's why I think in the coming probably few quarters, if we still see pricing still uncertain, and if that's a volume growth, you still have the natural penetration story. And aside from the domestic theme, I think a lot of Chinese consumer companies, they are looking for is actually overseas expansion. Although these tariffs make things a little bit complicated in the near term, but we still see that there's decent growth opportunities overseas. So by leveraging their established competitive edge in China, and especially I think it's the quick response to what consumers want, and there's still decent white space to grow globally.
Very quickly, what markets are those? Is that Europe, Southeast Asia?
It's actually everywhere.
Including the U.S.?
Yeah, including the U.S. and Europe. Yeah.
Interesting. Very nice. Goldman Sachs there, one of the reports they have here is the Goldman Sachs Guide to Chinese Restaurants. It's not, of course, a restaurant's guide, but really Chinese restaurants and how you play that. Michelle Cheng, thank you so much. Fantastic there out of Goldman. All right, a quick glance at these markets. 13 minutes into the cash market session. We're not doing well. We're coming off lows, I believe, in some cases. There we go, on your screens. Plenty more ahead. This is Bloomberg. Welcome back. Among the sectors we're tracking very closely, and there are many today given the sell-off, we're looking at property specifically on the back of this news of the abrupt resignation of the China Vanke chairman, who actually stepped in amid an already abrupt management overhaul back in January. So we'll continue to track this story. It's dragging down the space. We're down about 5% on the stock. We're down 3% on the sector.
Yep. So coming at a time when the financial position of the developer is already quite vulnerable here, and have a wall of really onshore debt maturities as well. So there you go. Some other big political stories that we're tracking for you today. President Trump has reiterated that the war in Gaza is over and that the truce will hold. He's traveling to Israel and is scheduled to address Parliament later on Monday. Now, if the deal holds, it would represent a major step towards lasting peace, something neither Trump nor his predecessor Joe Biden was able to secure in previous rounds of negotiations.
The war is over, okay? Do you understand that? I think people are, a lot of reasons why it's going to hold, but I think people are tired of it. It's been centuries, okay? Not just recent, it's been centuries. I think people are tired of it. Yeah, the ceasefire is going to hold.
Tensions are escalating in the South China Sea after the Philippines accused a Chinese ship of deliberately ramming a government vessel. The Philippine Coast Guard says the Chinese ship had already fired water cannon before the collision on Sunday, causing damage to its vessel but no injuries. The Chinese Coast Guard says it was conducting, quote, normal law enforcement operations near the Spratly Islands.
Right, let's stay in Southeast Asia here. So let's talk about Malaysia. So the second Minister of Finance says that the country's economy is actually being supported by strong private consumption. Speaking to Bloomberg, Amir Hamzah Azizan has also talked about the resilience of the country's currency, the ringgit, reflecting really the solid fundamentals of the economy, and also he expects more foreign inflows to continue.
If you look at it, we are first half year 190 billion of FDIs coming in and approved investments. We're seeing domestic investments also growing well. We've seen, if I use as a proxy, and I look back at EPF as a proxy of formal employment, EPF's contribution rates have gone up. It's growing at 9% compared to the previous year. So that's a sign that employment is still good. My money is still being pumped into the system. And the interventions that we're doing to lift the flow so that the citizenry has money in its hands are also helping drive private consumption. So I think those elements have actually created a resilience in the Malaysian economy. And therefore, people look at Malaysia in a slightly different form. And then with the slowing down of the growth of interest rates in other countries, particularly the US where they have been cutting, that's allowed the differential to get smaller, so the ringgit has equally strengthened.
Do you expect the inflows to pick up speed and further boost the currency in the next 12, 24 months?
I think it was important for us to make sure that 2026 is a year that we have enough built in to sustain the domestic economy. So I think that resilience will actually show value to investors going outside. The government fiscal reform is showing value to it. So we started off with a fiscal deficit to GDP of 6.4%. This year will end up at 3.8, next year will down at 3.5. So there is resolve. And if you see at all the reforms that we've been doing, it's about putting in fiscal discipline is coming in. And those are good signs to investors that are coming in. We've had a stable government, clarity of policy, and that's helped to attract investments.
So supporting the currency, the thing is, the ringgit's performance is also contingent on the dollar, which also depends on what the Fed does. Right now, expectations are perhaps for 2 cuts. But that may not happen. How do you see that playing out into your currency?
Well, even if you look at this year, there were expectations of further cuts, and further cuts didn't come in, right? But the ringgit still stayed resilient, because the fundamentals are still strong, and the differentials have remained quite reasonable along that line. So I think even if the Fed slows down its process, the ringgit still has a lot of wind behind it to be able to push ahead along the way.
Tariffs are a big uncertainty. You saw how, President Trump is imposing additional 100% tariffs on China, taking it to 130%. This is your largest trading partner, contributing to about 17% of overall trade. And some say 130% tariffs would mean stagflation, supply chain disruptions. How might that impact the Malaysian economy?
I think we've seen what's transpiring with the changing tariffs in the first half of the year. When we started the journey earlier, the signals were tariff is going to come in, it's going to rattle the markets quite dramatically. countries will have to do dramatic shifts in order to manage it. But over time, practicality started to come in because it's a very much more integrated supply chain that we're having on a global scale. So I think this recent shifts will probably also find a better landing in the not too distant future, and we'll come back to what is probably a practicable solution. And I think both sides are figuring that one out. So from a Malaysian point of view, the key is to actually understand what is the components of our trade. And our trade E&E and semiconductors, but we also have still the commodities and so on anchoring the trade. So if we continue to do those well, semiconductors, which is a very narrow supply chain, continues to tick on a better note, I think we'll be able to ride it out.
Some corporate stories we're tracking for you today. Didi Autonomous Driving says it's raised $280 million in a new round of financing. A statement posted on its official WeChat says investors include the Zhongguancun Science City Technology Growth Fund, GAC Group, and Didi itself. The company says the capital will be used to accelerate AI research and the deployment of level 4 autonomous driving technology. China Wanka's recently appointed chairman has resigned from the role in a new blow to the embattled developer facing liquidity challenges. Exchange filing says Xing's resignation is due to personal reasons. Wanka has elected Huang Liping as the new chairman. The surprise twist threatens to further cloud the outlook for Wanka ahead of a wall of onshore debt maturities.
All right, just very quickly looking at the chip space, semiconductors, this is across the region. So everything from Samsung, SK Hynix down, and TSMC is coming up as well. They're down substantially. The opposite is taking place with Cambricon now actually coming up. SMIC on your screens also seeing some upside. Again, perhaps a direct function of the trade rhetoric heating up yet again. And certainly these are some of the domestic plays there that have benefited from such pickup in rhetoric. Rare earth stocks coming up as well, doing very well. Again, rare earth very much in focus there because substantially well, 21%. So not all is bad going into the Monday session here. Just to also mention that U.S. assets, dollar yen coming up on your screens right now are showing markets are coming off the edge a little bit, although we are getting a lot of selling still. This might indicate maybe in a couple of hours things will peter out depending on the rhetoric that we've seen and heard so far out of the U.S. president. Plenty more ahead here on the China Show. Have a look at our guests coming through. This is Bloomberg.
Welcome back to the China Show. A look at the CSI 300 a half hour into the session, and you are seeing quite a bit of downside here. We're down about 1.5%. MSCI China is down by about 2%. This tumbling of equities certainly hasn't coincided with bonds taking a bit here this morning. Investors are certainly getting a little bit jittery when it comes to the latest, when it comes to U.S.-China trade tensions, this back and forth tit for tat that we saw over the weekend as well. We have seen at least the U.S. side come off a little bit in terms of the temperature and talking about, the door is still open when it comes to trade talks, but at least for now, we're still seeing a catch down story across onshore markets and here in Hong Kong.
Yeah, that's really on the back of the comments that the U.S. president made as he was making his way either onto Air Force One or on Air Force One. He's really toned down the rhetoric as far as that was concerned. It's taken the edge of markets. I think when you look at, to your point, U.S. assets right now are firmly in the green, but certainly what's worth pointing out as well is we haven't reversed fully the declines from Friday. So you split the difference between the two. We're not even halfway back. The MSCI China is down about 2%. Some of the big movers we're seeing on your screen, CSI 300 and the big names coming up very, very shortly. So it's not all red on your screens. You do have a bid coming through as far as the sort of your domestic chip plays like SMIC. Kingsoft is actually traded, of course, onshore. You are getting substantial upside there. But they are getting the drags. Goar Tech is a very good example of that. We're also looking at the 50-day moving average in the MSCI China. Certainly when you look at how, the Hang Seng futures on Friday fell to the limit of 5%. We were looking at several lines of support possibly that could be tested today. And as you can see on this one specifically, we are close, but not there just yet. Just to also mention that on the 50-day moving average, just watch it very, very closely and whether or not we do manage a bounce above that because we are seeing some pressure right now. The FIX, which came in on the stronger side, managing to also take some of the edge off some of the selling out there. there. So dollar China's coming up. Dollar yen was quoted weaker going into the Monday session. There's a separate conversation in Japan and politics, and what's happened to the coalition there might be adding more premia to Japanese assets. U.S. futures, as we were pointing out, Treasury futures are coming. You don't have, of course, Japanese cash markets up, but yeah, there we go. If yields were quoted today, we would be higher on the 2s and also the 10s. But yes, NASDAQ futures are now up 2% in the first few hours of trading here in the Asia Pacific.
Yeah, let's look back on what we've heard so far, really from both sides. President Trump says tariffs for China are still the plan, starting from November 1st. But speaking on board the Air Force One today, he called Chinese President Xi Jinping a, quote, smart man and a great leader.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. And I have a great relationship with him. I think we'll get it set. I know what happened. I really understand what happened. And I'm not even saying he's wrong. But then we met him with something much tougher than what he did to us. Again, because of the tariffs, it's much tougher.
Let's bring in our China correspondent, Min Lo. She joins us live from Shanghai here this morning. It seems like, at least for now, Trump is pulling negotiations back from the brink just a little bit.
That's right. Well, President Trump also wrote on Truth Social. He said, don't worry about China. Everything is going to be fine. And it seems like President Trump is anxious to reassure markets that this is not going to spiral out of control while he continues to put pressure on China to roll back some of the retaliatory moves that we have seen so far. We hear the same thing from J.D. Vance on Fox News as well, urging China to take the reasonable path here, saying the U.S. will reciprocate with reasonable measures as well. But so far, from the Chinese side, we have heard the Chinese Commerce Ministry saying that threatening China with tariffs at every turn is not the right way to deal with China, and China will not hesitate to retaliate as necessary to protect their legitimate rights and interests. And so far, we have seen the tightening of the rare earth controls as the strongest sort of long-arm jurisdiction that China has attempted so far when it comes to rare earths, because it applies to overseas exporter of products that contain even trace elements of Chinese rare earths. And this could have important implications on the tech supply chain, right? Analysts are saying it could cause a weeks-long delay of shipments of equipment from the likes of ASML. It could raise prices as well. And it seems like China is increasingly confident of the pain that they could inflict from its supply chain dominance. And they're willing to use that in exchange for tolerating incremental increases in the sort of export controls that we are seeing from the US, and even higher tariffs as well.
Well, yeah, Min, speaking of tariffs, it's strangely coincidental that trade numbers are actually set to come out at some point, in fact, any time now, really. And, you know, I wonder what the implications are when you look at trade, you look at some key dates as far as what we're watching is concerned. What options does China have now as we go into those trade talks and beyond them?
Well, of course, if the 100% tariffs, the additional 100% tariffs kick in, it could threaten to basically cut all trade between U.S. and China. But so far, as you said, looking at the trade numbers, China has seen trade hitting new records this year. It shows you that China is resilient and agile enough to really shift with the changing trade flows to increase its trade with other regions to offset the decline in shipments with the U.S. Of course, there's more sort of uncertainty ahead with the new levies being imposed on shipping vessels from both US, China. Both sides are imposing these levies on each other's vessels starting tomorrow. But again, in terms of what else is in China's toolbox, they still have other levers to pull. They have the ability to disrupt economic engines in the US, including, for example, companies like Apple and tech companies that are trying to, diversify their supply chain away from China. They are facing efforts that are being stalled by Beijing, which is restricting these companies from cooperating with the likes of Foxconn and Chinese contractors that are key and essential to their operations. You think about the Chinese market, it's still a huge market for really sensitive industries in the US, including agriculture as well as tobacco, parts, aircraft parts as well. So yes, we have up until early November when the new tariffs could kick in, and of course end of the month is when President Xi and Trump could possibly meet in South Korea. Whether that's still happening, we'll have to see.
Min, thank you. Min Lo in Shanghai for us, our China correspondent there. Let's have a look at the implications across FX market. It's been a crazy ride across FX. In fact, just to mention dollar yen, which you see on your screens, right? So as recently as 10 calendar days back, we were at 147. So if anyone told us back then that we would write a headline, the yen would strengthen to 151, we'd call them crazy back then. But here we are in this new range. Joining us now is Joey Chu, head of Asia FX Research at HSBC. Joey, good morning. So obviously we'll talk about the politics in Japan in a moment and what that means, but what do you make of the price action in FX markets this morning so far, given all the trade news so far from the weekend?
Well, I think we saw with a great sense of relief that the dollar CNY fixing came in at relatively low levels, sort of continuing the string of stronger than expected RMB fixing since they came back from Golden Week on 9th of October, right? We've been still stuck at this 710 type of handle, which I think is very good news and is a great anchor for the rest of dollar Asia amidst these times of volatility.
This is coming at a time when we're seeing the dollar rebound overall. I mean, obviously, we had some interesting central bank decisions out of Asia last week, surprise cuts in some ways. But is there a sense that this whole kind of big dollar short trade is now fading?
I mean, I think we've been getting such questions since the start of third quarter, which was also when, the dollar started to find a little bit of a footing, partly because a lot of the de-dollarization type of arguments sort of faded, and a lot of the hedging moves in dollar Taiwan, for example, also sort of subsided. But, overall, our view is still that the Fed is still cutting, and historically, when we look back, there were times when, during the times when the Fed cuts and the US does not go into recession, are actually precisely the times when the dollar actually weakens. So our base case is still weakening modestly of the dollar.
Okay, Joey, can I ask you about the yen specifically, because that one has both a dollar component and its own idiosyncratic weirdness recently, and apologies for the lack of a more diplomatic way to describe that. The argument recently is because of what's happened politically, the range on dollar yen has shifted up substantially. Would you subscribe to that view? What is that range now we're looking at on dollar yen?
Yeah, I think this uncertainty about, number one, in the first place, who is going to be the prime minister, and number two, whether there will be changes in this bias, be it for fiscal policy, monetary policy, currency policy, or even foreign policy. I think all these are great unknowns, and as we have seen in many times in history, especially with the U.S. over the turn of the year, changes in government can have huge changes in the currency. So I think no one's really wanting to take a lot of risk right now. So the uncertainty is just sort of lifting dollar yen up, especially if you consider where we have been coming from at the before the elections, when dollar yen actually fell quite a lot in the second quarter. So our view is that eventually the dust will settle and we'll find out about the policies. Our base case is still that no matter who comes into power, the fact is that cost of living is the number one issue in facing the Japanese public, and so a weak yen is just going to be detrimental to this issue. And so any political leader that comes in has to face this reality.
Should we still assume that the BOJ can hike, even with a pretty dovish, I could say, new prime minister?
So our view is still that the BOJ will hike, because ultimately it will be basing its views and its rationale on the economic fundamentals. Of course, politics can affect it because it can affect confidence, can affect investment decisions, and therefore affect the economy. But I think we have seen enough economic momentum or enough wage momentum onshore in Japan so far to judge that actually one rate hike is at least on the cards.
All right. Joey, you also mentioned, and apologies I forgot to ask you about this and to go deeper into this, but yeah, I mean, the fix today was, I guess in many ways, a reminder of something else that might help us sort of backstop some of the risk appetite out there. Should we continue? Do you expect the PBOC to continue to lean into yuan weakness?
So actually, our view is that the fixing stalling at about 710 to 711 for the last couple of months already is both a function of the DXY not really moving lower, as well as a function of the trade talks sort of progressing well enough, or up until recently, but there have been no concrete developments in tariffs. So I think both conditions remain in place. In fact, the second condition about the tariffs, arguably you could say that it's developing in the negative way. So for us, I think there is some risk of upside risk in dollar CNY fixing going a little bit higher than what we have seen recently. But I still think that at the end of the day, it's not going to be a currency war that we are thinking about.
Joey Chu, thank you, head of Asia FX Research at HSBC there. We're getting just some lines crossing. There's a press briefing for the Customs Bureau in China in Beijing right now, and we're hearing from the Customs Deputy Director Wang Jun speaking and basically saying when it comes to trade faces rising uncertainty, difficulties, and the external environment still complex. Of course, this on the back of what we've been hearing over the weekend and really this escalation, a re-escalation of the U.S.-China trade dispute and the like. So certainly that's the comments there. We're still waiting, though, the export numbers and import numbers from September. Yeah, they should be mentioning that at some point during this briefing, and we'll break those numbers to you once we have those trade numbers coming through as well. Interesting, maybe within that, what are we going to see as far as soybeans are concerned, or maybe the absence of which. Right, coming up here, we'll continue the conversation here on U.S.-China, and Hao Hong will be joining us out of Lotus Asset Management, who does see, of course, the latest moves as a strategic signal on the part of Beijing intended for the U.S. to get that message. Hao Hong joins us in a couple of minutes.
We do not make a lot of short-term trades, if you will. I think this is something that we've been watching for since, beginning of year. Yeah. I think one of the, as I mentioned earlier, this is one of the big ones that's still missing in terms of tariffs. Initially, thought that we have until like mid-November to decide, but I think this is something that is coming to fore now. I think the markets will adjust. We are relatively well positioned, I think, in terms of where we are right now. We're not looking to making any knee-jerk moves ahead of this news.
Zhikai Chen there, head of Asian and Global EM Equities at BNP Paribas Asset Management, speaking to us a little bit earlier on. Meanwhile, we're hearing from some of these financial newspapers in China saying that stock investors shouldn't be, quote, overly pessimistic despite external shocks. The Shanghai Securities News is citing brokerages who say traders should pay closer attention to China's economic transformation and capital market reforms.
Yeah, to help us sift through the noise and signal here, joining us here on set is Hao Hong, managing partner and CIO at Lotus Asset Management. How it's nice to see you. The market's done extremely well going into the weekend, yes. And then maybe for those who were looking for an opportunity to buy the dip or a dip, here's a dip for you today. Yes. Would you? What advice would you give to those people?
Yeah, well, I think we will be buyer of this dip, right? So we've been waiting for this. I think before this correction, the Chinese stocks has been going from strength to strength, especially the tech stocks. So I think for people who wanted to get into this trade, it's very difficult. All right, or not very, but it's trying to find a good position to get in, right? Mm-hmm. So now this is the chance, and I think the volatility will be with us for some time. Mm-hmm. But then this gives a period of building a window for building positions.
It's interesting though, but I think we didn't expect this in some ways. I don't know if you did, Powell, but what do you think is the reason, the motivation that China? In light of this move of imposing export curbs on rare earths, right? Because we're still, a few weeks away from APEC.
That's right. Yeah, I think judging from the market's response, I think most people were surprised by this move. I think China is retaliating, because before this, the U.S. is using the BIS affiliated route, basically blocking all the channels that China can get its hands on advanced semiconductor chips. So I think after that, if you see a series of Chinese retaliation, negotiation, right? So China is telling the leading tech firms not to buy NVIDIA chips. It's also showing confidence is Chinese-made chips, and also China is imposing fees on U.S. chips as well, for using Chinese ports. So leading up to this, right? So basically, we're becoming more restrictive on rare earths exports. Right? So I think people are seeing it as a sort of a retaliation to the previous U.S. move, but then over the weekend, Donald Trump basically retaliated by imposing 100% tariff on Chinese goods. So therefore, the market is rightly concerned. But I think judging from the history so far this year, more likely than not, we're going to get a tackle trade. Right? So Donald Trump is going to back off at this stage. For two of the leading countries in the world, no one can gain anything from hitting at each other.
Do you expect the posturing, though, to continue the next 2 weeks ahead of the meeting? And do you expect the meeting to still take place?
Yes. Well, I think both sides are still expecting the meeting to take place in a couple of weeks. And also, going into this meeting, China has to posture, right? So as still have cards on the table to play, and also telling the opposite side, where the bottom line is for this negotiation. Right? So in so doing, it actually helped for the meeting to become more successful, right? So if during the meeting, China trying to change track and trying to retaliate after the meeting starts, then I think it will be a even worse starting point for the meeting.
Okay, so if this is the window opportunity to buy, what is worth scooping up right now, right? Because up until now it's been growth, right?
Yes.
Is it time to sustain growth, or is it time to actually rotate?
Yeah, I think people has done tremendously well with the growth stocks, right? So if you look at the Star 50 index in China, it's up like 180% in the past 12 months, right? So it's the leading performing index in the world. I think by now people has done so well, and also because the relative performance has been so extreme, then it actually pays to rotate some of the money back to the value stocks. So in the past couple of months, as growth stocks start to rally, Chinese banks, insurance, brokers hasn't been catching up as much. But these are the names that is very steady. It's heavy index weight, and so as money rotate back to these stocks, then we expect that these stocks will lift the Chinese index higher from here.
I'm looking at some of the valuations. I'm just going to mention SMIC as an example. Trading at 160 times earnings. I think your reaction says everything. But so what do you think expectations are? Do you think expectations are slightly too high as far as AI is concerned in China? Or how do I play that?
Well, I think everybody is going for AI, right? So it's going to change the way we work. I think specific for SMIC, we have a position in the stock. Okay. To declare, but then
thank you for that.
Then at the same time, we're expecting earnings to double from here, right? So rapid earnings growth from here. Yeah. So as a result, even though now the PE is like very very high, right? So but for growth stocks, 100 200 times PE is actually showing the growth potential that people are willing to pay for, right? So at this price, so one shouldn't be too surprised to see the stock continue to do well, and also earnings starting to catch up. Therefore, then you will see PE ratio actually comes down because earnings is going faster than the price.
Okay. What should I look for in terms of ways to measure trade war tensions, the proxies that you've been looking at everything from soybeans to semiconductors. Yes. What's the right sort of one to look at?
Yeah, I think a number of indicators we can keep track on. One is the soybean you mentioned, semiconductor performance, and also the Chinese yuan, right? So this morning, we see Chinese yuan is actually have a stronger reference rate, so meaning China is actually not retaliating after the U.S. imposing 100% tariff, and also the U.S. long bond yields, right? So and the Chinese long bond yield as well. So many of these indicators is going to tell you what the market thinks. But then I think the most direct way to measure is the polling market, right? So the prediction market. So they have a bet, whether China can resolve these conflicts around the APEC summit. I think right now the chance is like 90%-ish, right? So there's the market is actually quite optimistic of the outlook.
What do you think the risk premium should be after this meeting? Because this, to me, is a reminder that markets forgot about this issue.
Yes.
Right? We forgot about it, and then the weekend I woke up Saturday morning.
Yes.
Yeah, that it could still flare up. So what do you think the appropriate risk premium should be after this meeting, assuming poly market is correct?
Yeah, well, I think, there would be like back and forth, between now and leading up to the summit. And also I think, for the Chinese yuan, the Chinese central bank is sending a signal that China doesn't want a war, but, if there's a war, China is ready for it. And also, for the risk preference sake, for the Hang Seng, for example, right? So Hang Seng is about, 26,000-ish, right? So it's actually at a higher level than the beginning of this year. And you can see the lower point of the Hang Seng index is actually rising. Right? So one should be, we're very comfortable with Hang Seng being at about, 25,000 is a buying opportunity.
Okay, just in 10 seconds or so, do you think the national team might come in to stabilize in case the onshore market starts to fall even further?
Yeah, I think, judging from this morning's performance, I think, the national team is at rest, is quite relaxed at the situation.
All right.
And I think many people are looking for buying opportunities.
Hong, thank you so much. Managing Partner, CIO at Lotus Asset Management. Coming up here on the China Show, Eurasia Group's China Practice Head will be joining us in a couple of minutes. This is Bloomberg. Looking at the Japanese futures market, more uncertainty on the political side. According to Kyodo News, the Komeito party is saying it does not rule out cooperation with the opposition, and that exercise is focused on the nomination of the prime minister. More uncertainty out there. Japanese futures, there we go, as we promised, coming up on your screens. We're down 2% on equity futures.
Washington is dealing with a much more assertive Beijing. China is prepared this time around. It has put tools in place to respond to U.S. measures. It has reduced its dependence on U.S. imports and has reduced dependence on its exports to the United States by forging relations with other countries, particularly increasing its trade flows with Southeast Asia, and it's increased its self-sufficiency, as well as it's identified its choke points where it can hurt the United States.
That was Wendy Cutler there, the Vice President of the Asia Society Policy Institute, in the latest flare-up, unexpected flare-up, looking at where markets are right now in terms of the U.S.-China trade conversation. For more analysis on where we go next as far as the relationship goes here, let's bring in Eurasia Group's China Practice Head and former U.S. diplomat David Meale here with us on set. Quite timely and perfect timing, really, to have you join us. Thank you so much for taking the time. So why are we here? Like, why is this happening all of a sudden?
Yeah, well, thanks, David. Thanks, Yvonne, for having me today. I'm glad I happen to be in Hong Kong. Why are we here? Well, I actually think the two sides were on a good path towards having the meeting at APEC and then for Trump to travel to China next year. And I'm still optimistic about that. But along the way, there was this closing of a loophole on the U.S. side, this new 50% rule that came out. And the Chinese saw it as more than perhaps it was intended to be. And then now we have the new Chinese release of these rare earth elements and related technology export control rules. And then President Trump has responded with his threat on tariffs. So it's been a back and forth that I think really reflects how concerned each side is about communicating where its pain points are and the necessity of the other side to help drive this car between those pain points.
Yeah. You mentioned some of these loopholes. Can you decipher what is actually new and what's not new? in these curves in particular?
Well, the new U.S. rule essentially expands how export controls apply to subsidiaries that are tied to Chinese companies. And by some estimates, the number of affected companies goes from something like 1,200 to over 10,000. So it is a significant new rule. It is impactful. Whether the U.S. intended for it to come across and be understood that way, I am not sure. I think they think about these things for a long time, and maybe it is correct that from their point of view, they were just tightening things up.
Does it change at all the likely scenarios at the APEC meeting, assuming that meeting still goes ahead?
I'm going to go with it. It does not change APEC. I think the two sides are already signaling that they want that meeting to go on. Okay. President Trump's post on Truth Social overnight suggested this as an episode that I think he called it a bad day or something close to that, that they will get past. But perhaps it will delay the process a bit for getting to the transactional trade deal that we're all anticipating. I mean, at Eurasia, we're still holding to our call that the two sides will reach this deal. I think it's likely to be on the occasion of whenever Trump does get to China. But I do wonder if APEC, the result of that will be the two sides agreeing they need some more time just to hammer things out, hammer out what the actual meaning is of each of these moves that the U.S. and China have made, and come up with reassurance that the outcomes of these export control moves, it will not affect the reliability of industry getting what it needs to function.
I mean, I'm just wondering what could come next. I'm just wondering in terms of, now that we see the threat of 100% tariffs from the U.S., in terms of China's response, what do I look like? Is this TikTok deal in jeopardy? Are soybeans continue to be a sore spot?
So I think that's what would come next, would be a reminder of all the ways that each side can inflict pain. Let me step back, though. I was just in China for 2 weeks.
Sure.
Talked to a lot of my old government contacts, people in think tanks, businesses, and so on. And I came away with the impression that the Chinese really feel they can work with Donald Trump, that they see him as pragmatic, as transactional, as somebody who shows respect to President Xi. And what they really want to get to is getting to more stability and predictability in the relationship that they envision could last through Donald Trump's term.
Do they feel like they have the upper hand, though, China, right now?
They felt they played the rare earths issue last April very well. That was clear. But they also know that the U.S. holds a lot of cards. And we saw some of those cards last April, actually, when Trump responded with the controls on the chips and on the jet engines, on the ethane gas. So I think what both sides know is neither can move in a direction that serves its sole advantage. Each side has very serious pain points.
In my head, the timeline moves into next year when possibly, to your point, Donald Trump makes a trip to China, possibly, and then the U.S. midterms are rolling around. How do you think the U.S. midterms might affect Donald Trump's orientation?
Well, I think both Presidents Trump and Xi are extending themselves a bit by planning on these two meetings. And, I mean, they're clearly working towards getting to a deal.
Right.
But for both of them, they're going to have some pushback from people in their capitals. Mm-hmm. For Donald Trump, we can already see from the hawkish elements that there is a lot of concern about what he is going to do next. Mm-hmm. So whatever he does, he is going to have a strong motive to make sure it is successful. And that gives me optimism about the implementation of a deal. The midterms will be part of that, but it's more than that. China is hosting APEC next year. The U.S. is hosting the G20. Along the way, there are going to be a lot of opportunities for people to meet at the ministerial level. Yeah. And then at the end of the year, there's going to be opportunities for leaders to get together at the leadership level. All of this, I mean, from my experience working, basically 30 years on U.S.-China, nothing works for this relationship like scheduling high-level meetings. It gets the bureaucracies on each side to kind of sit up straight and figure out what's possible. And I think that's actually setting us up potentially for a good 2026 if they can get to a deal, if they can get past this episode, and if they can implement well.
Where does Taiwan fit into all this?
We saw what looked like some gestures from Donald Trump in recent months. The Lai transit of the United States did not happen. Defense talks were downgraded. There were some other measures as well. The Chinese are clearly looking with high hopes to Donald Trump to give them reassurance that the United States is moving away from what they felt was the quote-unquote hollowing out of Taiwan policy, of U.S. one China policy in the Biden days. And so I think now what they are hoping for is that at minimum, Donald Trump, when he visits Beijing or at some point around that, makes a very clear public reaffirmation of U.S. policy. And that will allow them to feel that the U.S. is not implicitly sending signals to the Taiwan leadership that it is going to tolerate what the Chinese fear will be provocative moves by President Lai.
I mean, it sounds like an oxymoron to get more clarity on the strategic ambiguity sort of policy, but how much goodwill do you think Donald Trump is able to get for U.S. companies if he leans in that direction and gives China what they want?
I am hesitant to suggest that Donald Trump is going to actually act in a way that links a trade deal or actions to help U.S. companies to what he does on Taiwan. I think Taiwan exists on its own merits. It is the most important issue to the Chinese. Remember, when Trump and Xi have phone calls, we always learn that no matter what the central element of the call is, the Chinese always raise Taiwan. It is their number one priority to move that forward. And so I think Donald Trump recognizes that in this region, cross-strait issues are a source of potential instability. He does want an overall productive relationship with the Chinese, and I think it is those issues alone that will drive how he responds on Taiwan. That said, the gestures over the summer were probably to some extent a reaction to an understanding that after the tit-for-tat that occurred last April, a path towards the two sides getting to a trade deal and stabilizing the relationship had to occur against a backdrop of no major flare-ups over Taiwan.
Oh, of course, it's something to monitor. We have the plenum coming up. We also have this 15th five-year plan.
Yeah.
What are you going to be watching out for the most? Do you think some of these external threats that China is seeing right now, does it change the playbook in any way?
I think when we talk about these external threats, what's really motivating China is it doesn't want to have to think about those because it has internal business to take care of. When I was in China in these recent weeks, what I heard the most about was this concept of involution, this idea that there is this destructive downward spiral of competition that is affecting not just sectors in the economy, but now pushing through the entire economy. I think what we want to look for the fourth plenum and for the 15th five-year plan is what China plans to do about this. I expect we will hear that they will express determination to act here, to address deflation, to address falling margins, to address youth unemployment, to address cannibalization of R&D expenditures, issues like this that come out of involution. They are very concerned, but it is very hard to follow through, and I will be looking to understand what exactly they see as their tools and what they will be doing about this.
Do you get a sense that these domestic issues are at the very top of their priority, and not so much all these, let's call them distractions on the trade front? What do you think is top of their priorities as far as your understanding goes from the people that you talk to?
My understanding is, like all countries, they're thinking about their own country first and domestic issues first. They are actually quite happy with how their economy performed in the first half of last year, but they know that the consumer stimulus that they employed can't be effective forever. Right. They know this involution issue is there. They know that exports are a top source of growth for them, and they're hitting resistance resistance with the United States and eventually with the EU and other markets. So now they need to turn inward and focus on the property sector, on youth unemployment, on consumer sentiment, on involution. And I expect that we're going to see determination on that front.
David, it's great to have you in town. Thank you so much. David Meale there, Eurasia Group's China practice head, joining us here in Hong Kong. We also did hear from the S4 Capital chairman and founder, Martin Sorrell, saying that he remains super bullish on China despite Trump's new tariff threats. Speaking to us at the International Business Leaders Advisory Council conference in Shanghai, Sorrell explained how tariffs are impacting the advertising industry.
We have to see how tariffs sort of come out at the end of the day. We'll see what happens, particularly with the negotiation between the US and China. Having said that, all that does is delay things. I mean, people, when there's an uncertainty, they don't make this. I'm talking about the advertising industry now. They don't make decisions as quickly as they should do, or they postpone making a decision because they're uncertain about the results. So it's not good news. Growth as a whole is going to be lower. I think we've entered a new age of fragmentation, and growth is lower. Inflation is more stubborn, as we know with the central banks. They try to get inflation down. It's much more stubborn and tariffs don't help.
You talk about slow growth being the new normal.
Not slow growth, but it's sort of under 3% rather than over 3%.
What is your assessment of China and how and whether it will be coming out of this?
I remain super bullish on China. I mean, despite problems in the real estate market, which we still have, the stock market probably has improved a little bit from where it was this time last year with IBLAC. State-owned enterprises borrowings, I mean, that is being addressed.
Consumption sentiment is still pretty weak, though.
No, it's true. I mean, consumer sentiment, but Chinese always save a lot. The big opportunity for China is in the tariff world that you mentioned and we were discussing. As the trade patterns alter and the US will have to become, in my view, less important to China. It'll still be important, but less important. China is already diversifying its trade policy. Very interesting, even since April.
But we've been seeing very compressed margins, though, domestically because of the deflationary pressures. Do you see that changing anytime soon? Deflation is an issue in the Chinese economy that we has to be dealt with. No, I think China has enough. The government has enough fiscal firepower at the centre to deal with the situation. The priority for domestic Chinese companies is outbound China. The big opportunity for Chinese companies is outbound China. The big opportunity for Chinese companies is outbound China. They need, I believe, our help in marketing. You have to be very acutely aware of what goes on here in the Chinese consumer. And there's not one Chinese consumer, obviously. Foreign companies come in here know that it's going to be super competitive and they have to be super efficient and super agile.
Yeah, there we go. That was S4 Capital Chairman Martin Sorrell there with Min, of course, in Shanghai just over the weekend. Very quickly, we are about just an hour and 14 minutes to the cash market session, and we're doing better given the circumstances out there. We're certainly coming off lows of the day. We're now just down about 2%. Shanghai comp CSI 300 down as much as, I think, 2.5% in the opening minutes have certainly come off lows of the day. Welcome back. So the NBA has returned to China with some preseason games in Macau, 6 years after the fallout, of course, over the protests in Hong Kong put the relationship on ice. Stephen Engel, our chief North Asia correspondent, sent this report.
Six-time NBA All-Star and Hall of Famer Mitch Richmond is part of the NBA's, dare I say, full-court press to win back fans in China after a 6-year freeze of its annual China Games. You could say the relationship has been hit and miss. The league had been playing preseason games on the mainland since 2004, building a massive and lucrative fan base. That came to a screeching halt in 2019 after one team executive posted on social media support for Hong Kong's protests, angering Beijing. 6 years on, the NBA China Games are back, but now in the Chinese gambling hub of Macau through a multi-year deal with Las Vegas Sands.
There's a lot going on with basketball in terms of its future potential, but I think it's going to be investment-led. And I think there's a huge opportunity here in China.
Simply put, China is a market that's too big for the NBA to ignore. And for China, the NBA is too popular for it to ignore. S&P says a staggering half of China's adult netizens watch NBA games online, including one NBA player who's from China.
I feel blessed, be a part of this family. Since I was a kid, I was watching on the TV. Right now, it's like a dream come true for me.
From my perspective, it's always been an extreme amount of love. I have, a tremendous amount of respect for, the country of China, and they have the same for us.
A sentiment echoed by former football great David Beckham, who was on hand as a multiple brand ambassador in China and told me he believes sports has the ability to break down barriers. Soft power, if you will.
My connection started a long time ago with China. And every time that I go into a new country, a new city, I jump into the culture straight away. So it's about the food, it's about the people, it's about the fans.
This year's NBA China Games in Macau feature two teams that, while they've come close, have actually never won the NBA title. But there may be another prize at hand, and that is winning over fans for their teams in the Greater China region, especially now that the former Houston Rockets center Yao Ming has been out of the league for more than a decade now. The two teams are the Phoenix Suns at the far basket and also the Brooklyn Nets. Oh, by the way, the Nets are owned by Alibaba co-founder Joe Tsai.
Yao Ming is no longer with the Houston Rockets, and I'd rather spend more time in New York than in Houston, and I'm going to make the Nets China's team.
Call it a draw on China bragging rights as the Nets and Suns split their two games here at the Venetian Arena. Stephen Engel, Bloomberg News, Macau.
So cool. All right, if you're a subscriber and want to rewatch all the interviews and Steve's package, of course, you can watch it through our interactive TV function, TV Go. You can also become part of the conversation and send us instant messages. Check it out at TV Go. All right, chicken markets, chicken movers here this morning, and you continue to see some downside when it comes to Hang Seng. We're down by about 2% here right now. You are seeing a little bit of strength coming through in the currency here, of course, after that strong fixing from the PBOC here today. But certainly in terms of what to watch, or watching some of the key technicals, or watching the likes of rare earths, for example. Of course, they have been at the center of this whole U.S.-China trade spat as well. So some of what they've seen in Australia and China have been climbing as we continue to watch some of these developments coming through here as well. But you've been watching some of the technicals overall, Dave.
Yeah, going into today, I mean, looking at the drop that we had on Friday did indicate maybe a 3% drop was likely going to be one of the scenarios to consider today. And a 3% would have taken us to the blue line, which is the 50-day, which is effectively where we are right now. This note just dropped in our inboxes. This is out of UBS, James Wang and his team. And he says, the question is this a replay of the April sell-off? And he says, we don't get to that point quite a bit. We will see some bottom fishing, which he says will lead to the index bouncing off. If any, we test the 74 handle. This is what he had to say here.
Yeah, well supported, he says, right? That would bring us back to levels that we saw in May 9th, right before the previous tariff de-escalation, and 15% from some of the current levels here so far. So that's the take from the UBS side of things here. We talked about what really has been the pain point, or at least where we're seeing the biggest price action. For one thing, it's the rare earth stocks. So those have been actually moving on the upside here when it comes to Australia, in China, for example, here, as of course the spat intensifies. So there you go. You actually are seeing quite a bit of movement there. China exporter stocks, certainly that's sort of be the focus here, given the threat, of course, of 100% tariffs on Chinese goods. There you go. You are seeing a bit of a movement there to the downside. Tongfu Microelectronics, for example, is down some 5%. EV makers also is part of that story, I guess you could say, when it comes to the exporters side of things as well. But there you go. You are seeing, because we did see some and EV sales did grow about 15.5%, but today it really is kind of a risk-off session in some of these, especially when it comes to China tech overall, Dave.
Yeah, in fact, just on the Alibaba note, and that's coming up on your screens right now, this one actually just coming through in the last hour or so. So higher, which is not the description of the direction, not of markets today. That's the appliance maker, of course, coming through with Alibaba and signing this AI cooperation pact. Scant on details. This was a statement out of WeChat, or put on WeChat. The partnership between the two will focus on areas like AI plus cloud, advanced manufacturing, also e-commerce, and also global expansion. Just a note, but of course today's we're a catch-down trade as far as both things go. Before we wrap up the show, a look at in the next hour. So we're looking at this massive move on Friday in overnight HIBOR, that spike you see of about 107 basis points to 245. This updates in about 15 minutes or so, but we will leave you with a look. So something on positive notes. Markets are coming off the lows. U.S. futures, dollar yen, VIX futures are also, as you can see, not acting as much dollar, and we're also looking at Aussie yen, of course, which is a good indicator of risk appetite.
Yeah, as Hao Hong mentioned, right? If you take a look at what poly market and when some people are betting on whether we still continue to see some sort of resolution on the trade front as well, you see signs possibly of that taco trade maybe reemerging here this morning. That's it for us here on the China Show. Insight is next.